Welcome to Money Mix. This video is about Bank Negara Malaysia. For our introduction, I would like to introduce my group members, history and background of Bank Negara Malaysia. Bank Negara Malaysia of Malaya Ordinance 1959, which established the BNM, was enforced on January 26, 1959. BNM, its main purpose to issue currency, act as banker and advisor to the government Malaysia and regulate the country's financial institutions, credit system and monetary policy. This is the information about Bank Negara Malaysia. These are the current governors of Bank Negara Malaysia. Our current governor now is Tan Sri Muhammad bin Ibrahim. So, let us talk about the main content of this video. Before we talk about monetary policy in Bank Negara Malaysia, what is actually monetary policy? Monetary policy is the macroeconomic policy laid down by the central bank. It includes management of money supply and interest rate and is the demand-side economic policy used by the government of a country to achieve macroeconomic objectives like inflation, consumption, growth and liquidity. The Bank Negara Malaysia uses three monetary policy tools to control the money supply, such as required reserve ratio, the discount rate, and open market operation. The Bank Negara sets required reserve ratios, which are the minimum percentages of deposits that depository institution must hold as reserves. The Bank Negara does not change these ratios very often. How does required reserve ratio works? An increase in the required reserve ratio boosts the required reserve that banks must hold, decreases their lending, and decreases the quantity of money. As a result, it raises the reserve ratio, lowers the money multiplier, and decreases the money supply. Second, the discount rate. First, the discount rate is the interest rate at which the BNM stands ready to lend reserves to commercial banks. Second, interest rate that Bank Negara charge when giving out loans to commercial banks. How does the discount rate works? An increase in the discount rate raises the cost of borrowing reserves from the BNM, decreases banks' reserves, which decreases their lending and decreases the quantity of money. The third one is money market operations. Open market operations, the purchase and sale of government securities in financial market. So, as to influence the size of bank deposits, government has to authorize the BNM to buy and sell government securities. How does an open market operation works? When BNM sells securities in the open market, it receives payment in cash paid in the form of commercial bank checks, such as the cash balances of the banks will decrease, reduces their lending activities, and this results in the reduction of credit available. When BNM buys securities, it pays cash to the banks, and this will increase the bank's cash balances and enable them to increase credit for their customers. Let's move on to the function interest rate in monetary policy. The first one is to maintain price stability and a stable exchange rate. Following is the issues that has been raised on interest rate. This statement aims to clarify the current monetary policy stance. Interest rate policy continues to aim balance the need to maintain price stability and stable exchange rate while ensuring the productive activity is not undermined. The second function of interest rate in monetary policy is containing inflationary pressures and promoting exchange rate stability. In the current environment, inflationary pressures need to be contained so as to preserve the domestic purchasing power, especially for medium and lower income groups. Containing inflationary pressures and promoting exchange rate stability are also necessary to rebuild market confidence and to maintain international competitiveness. The third one is to earn a positive real rate of return. Interest rates have to be at levels that will allow savers to earn a positive real rate of return. At the current interest rate level, the real rate of return on deposits, after taking into account the expected rate of inflation, is being maintained at levels prevailing before crisis. This has allowed saving in Malaysia to continue to be efficiently mobilized a significant volume. Next, the relationship between interest rate with strength of currency and the price level. In economic theory, if the interest rate in one country increases, then the currency value of that country will increase as a reaction. If the interest rate decreases, then the opposite effect of depreciating currency value will take place. However, if the central bank of a country might increase in interest rate in order to defend the local currency by causing it to appreciate in value in respect to foreign currencies. Now, let us look at the price level or inflation. The interest rate acts as a price for holding or loaning money. Bank pays interest rate on savings in order to attract depositors. Banks also receive an interest rate for money that is loaned from their depositors. When interest rates are low, individuals and businesses tend to demand more loans. Each bank loans increases the money supply in a fractional reserve banking system. According to the quantity theory of money, a growing money supply increases inflation. Thus, a low interest rate tends to result in more information, high interest rates, and to lower inflation. The impact of interest rate adjustment towards Malaysia economic's performance if the interest rate is low. First, give consumer more money to spend. Second, encourages them to make large equipment purchases. Third, productivity will increase. And the last one is consumers have more disposable income. As rate increases, consumer will cut back on spending, productivity will decrease, and consumers do not have much as disposable income. That's all for our video about Bank Negara Malaysia. Thank you for watching.